we would like to ask, how best can I keep money without losing its value? Do you recommend a saving account? And if you do not, why? And if you do, how long should I keep my 10,000 shillings on a saving account? Because whenever you talk about keeping money, that's what happens, that's what comes to the mind of everyone. Open an account so that you save. If I'm a salary earner like me, when I earn $1 million shilling every month, it is highly recommended by you, accountants and money teachers, that I keep at least 10% of that for savings, like you call it. So, question: how can I immunize myself from having my money lose value?
Now, I'll start answering that question from the reason why people work.
Okay?
The reason why you and me and anyone out there works is to give out the value they have in form of their service in exchange for the value they don't have.
Okay.
And the value they don't have is the food, the clothing, the shelter, the means of transport, and all that. Now, many times when you work, you get more money than you need presently to cater for the value you need, to cater for your needs.
Okay.
That means that you'll have extra money or tools. We said money is a tool which towards the value. So you'll have more value left over at the end of 1 month than you needed in that month.
Okay.
So what most people resort to is to store that value.
Okay.
Because you've eaten, you've clothed, you've had shelter, you've moved from place to place using the money you made, but then you still have more money left over at the end of the month. Now, because you have more money left over, you need to store it. Okay? So many accountants and people in the finance field encourage others to save money on a savings account in a piggy bank. And
in fact, that's what we do. Even our little children, we say, "Oh, this is her pig bank. This is his piggy bank," and so on. And then an account and so on. So
but that's very false. That's a very false or wrong way of storing the value which you have in money.
Okay.
Because money is supposed to store value, and you're using your currency to store that value. As I told you that money at best can store, the Ugandan shilling can store value intact for
3 months.
For 3 to 6 months. In good times, can store the value up to 6 months.
Where here value means what it can purchase.
What is purchasing power?
Okay.
Money can hold. The Ugandan shilling can hold onto its purchasing power for
between 3
to 6
to
months.
6 months.
Yeah.
In other words, if 5,000 shillings can purchase a chicken drumstick, now we give it a period of 3 to 6 months.
Yeah.
After 6 months, it might not.
It might not. 10 million shillings can buy you a plot now, a plot of land now in Juenda, but in 6 months, you may need 11 million shillings. So it would have lost value. That's what I'm talking about. So the purchasing power of money, its value.
How many items it can purchase.
Yeah.
How many items of value it can purchase.
Since you've established that a Ugandan shilling note can keep its purchasing power for up to 6 months, that means that you can only save money for up to 6 months without losing its value. So I encourage people to use piggy banks and to use their savings accounts for not more than 6 months, because they risk losing the purchasing power of the currency which is stored there.
That is a note. I can't just miss that. If you are to keep this on your account, let it not exceed 6 months. If you kept it there in January the 1st, it should end June the 31st.
And now, I want to tell you before I move on to the best keepers or stores of value, I want to tell you why people are encouraged by accountants and financiers and the wealthy to keep money, to store value in money for longer than 6 months, for 3 years, for 5 years. Because people in finance advise everyone else, the working class, to keep money for long periods of time. Actually, I've had people advise others that if you want to buy a plot in 5 years from now, you need to keep money every month for 5 years to raise the money. If, for example, you want to buy a 60 million plot of land or a 60 million vehicle, you keep 1 million every month. You save 1 million every month for 60 months, which is 5 years, and then you buy that car, and then you build that house, and then you buy that plot of land. But these people, many of these people are telling you to do that, know the truth, and they themselves do not keep money for more than 6 months. Actually, but they do it deliberately, because under capitalism, you need to raise capital to invest. These are capitalists. They need to raise capital to invest, which capital they don't have, or they have little. For example, someone may need 1 billion Uganda shillings to invest in a factory, and they have only 500 million Ugandan shillings. So what this person does, you have to encourage 500 Lugolobis or Peters to save 1 million every month. And when they save that 1 million, you go and borrow it and invest it. So these capitalists, they encourage you to save not for your good, but for their own good, because they're going to save that money in a bank, your bank saving account, and your bank is going to get the money out of the bank account and give it to the investor or to the proprietor, entrepreneur.
So would you advise that if I wanted to buy a Subaru Forester 2015 and it goes for 60 million Uganda shillings, and as I speak now, I have 30 million. Would you advise that I deposit this 30 million with the bond owners or with the car owner, so that meanwhile I drive while I'm waiting to make the 60 million? Should I give them the 30 million and meanwhile I drive? Would you advise that I do that, so that I start utilizing the value with the money I have as I pay bits and pieces?
Actually,
would it be financially prudent?
It's very financially prudent to follow the people who use value best. The people who use value best, and those are the wealthy people and the entrepreneurs and the capitalists, they do not keep value. They wouldn't keep the 30 millions in a bank account as they wait to get the extra 30 millions, or they save for the extra 30 millions.
Okay.
What they do, they look at their current cash flows, and if they establish that they can pay back a loan of 30 millions within maybe 1 year by paying 3 millions every month. For example, if you're earning maybe 7 million or 6 millions, and your lifestyle costs are 3 millions, so you have a leftover of 3 millions every month. That means that you can go to a bank, and the bank can loan you 30 millions, and you top up onto the other 30 millions, and you drive away with your car. Then every month you pay the bank 3 millions.
So that means if the car goes for 30 million, and currently I have 24 million, if I'm going to bargain, if I will bargain with the car owner, and I say I have 24 million, I will pay the 6 remaining million in the next 6 months. Am I speaking in a financially literate manner?
Very financially literate. Very financially literate. And not only for luxury or for for lifestyle expenses. But even when you're investing, it makes sense for you to invest now than in 5 years' time. Because if you're looking for capital to put up a factory and you start saving now for a particular factory, for example, you're going to make what gadget can you're going to publish
Books, yes.
your teacher, you're going to publish books.
Yes.
Now imagine you're saving for books and the capital you need is 100 millions, and you can only save up 100 millions in 3 years. Now, by the time you raise the 100 millions after 3 years, that book may be irrelevant, or a better book will have been published. So you have lost out on the value.
The more current the value, the better.
It's called the time value of money.
Time value.
Time value of money. Money is time sensitive because money loses value. The currency loses value over time. So, what you need, whatever you need or want, whatever value you need or want, you want it now. You don't want it in 3 years' time.
Whatever value you need, you need it now, not in 10 years' time. When we come back.